because there's a certain pride that people take in saying, I actually got a bargain. And then on the other side of the coin, there's an equal amount of pride from a vendor saying, actually I got an excellent price for my business. So what is the right price? Now, there's a lot said about multiples, and various sizes of business will be sold on existing prices in the marketplace. So if you're buying a bakery, you can probably find out what the average price for bakeries is in that area or in that city. When you get business that's a little bit larger, you start to talk earning multiples. So if you're making, say, $1 million in EBITDA, I've got X amount of assets, stock, I've got some creditors, some fixed assets, what's the actual price you're willing to pay? It all comes down, I suppose, to what is the actual multiple based on? Because the more people you talk to, the more answers you will get. You actually have to decide in your own mind how you measure profitability or cash flow that's going to come out of that business. So there is the standard one that I see quite often is earnings before proprietor's income, interest, depreciation, amortization and tax. And there's an acronym for it, but I can't pronounce it. Now that's fine, but it doesn't tell you what you will make as a passive investor. And then the next question is, the next point I'll be told is, well actually I don't want to be a passive investor, I want to buy a job. I want to actually get in there and make it work myself because I'm better than whoever has it now. So there's a different measure for that. What we look at is the predictability of earnings. We base it on what we like, and we happen to like EBIT. It works in our industrial sector. You talk to people around the barbecue and they'll say, oh, I got 4 times earnings for my business. And the question is, earnings again, is it EBITDA, is it EBIT, is it excluding proprietor's earnings? Is that EBITDA on your budget going forward, or was that simply last year's result? So if you're growing at 10% a year and you expected last year's result, you may have sold yourself short. Don't know. And what does that exclude? There's some leases. Does the owner's wife's car, is that leased by the business? Has he excluded that? All the normalisation issues as well. So normalisation is one of those things where 10 years ago not too many people did it. Now everyone's well educated, so they will take out the kids' school fees, they'll take out the wife's fuel, the boat, which is called repairs and maintenance, which is a common name for boats. So you've got to understand what they're actually putting out and what you need to can actually replicate.
So the important thing to remember there, when someone says what they think you might be able to realise, is that if your mate has told you something else around the barbecue, you can take a hefty snip off what he's told you, because that figure has been manipulated, either so you can say it to other people, or she can say it to other people, or simply because that's the way it's presented. There's a lot of games that you can play with that. And we've heard other people speaking about the same thing in the past. The reality is, you are not going to believe the price you get is the right price unless you're really lucky. 5 years down the track, you might do. 1 or 2 years down the track, when the staff that have remained have caught up with you with a beer and told you about the things that the new owner had to learn and the mistakes that they made, you might start to think that. But you have to recognise it may be one of those things, because it's so important, because it's so pivotal, because it's so emotional, that you're never actually going to be fully satisfied with what you get. It's the nature of human nature. Because unless you can put yourself in that purchaser's shoes, unless you can smell their fear, unless you can understand their worry, unless you can appreciate the concern about what they're putting on their line, and that they don't know all the things that you know, they don't know how certain that is, they worry that every contract comes from relationships. Unless you can do that, you're always going to think it's worth more than they do. I'll give you an example. It's a heavy transport industry. A few months ago, yeah, it looks quite nice. But actually, our thought there was it sounded like most of the work delivering enormous digging trucks from one mine to another, we suspected it came down to the current owner fishing, golfing or drinking with the guys who ran the mining companies there. And therefore, in our eyes, you were taking a massive risk and a big hit, and we wouldn't pay for that. So you've got to think, what does a stranger who comes and sees this, what do they think about it? Because if you can't put yourselves in your shoes, you're never going to understand why they're offering what they offer. Okay, this is the two in the row one, that's right. How to get the right price? You need to start 3 years before you really want to sell. I echo the point that Karen made about always being in a position to do that. Most of the things that are good practice in running a business will turn out to be extremely valuable when you get there. If you were to pay an independent director and you didn't have the skills to produce the management reports, he or she will cost you 20 grand a year, and the extra accounting work probably another 5 grand. If you did that for 3 years, that would cost you 75,000. But if we're talking about selling a business for 2 or 3 million, would we pay more than $75,000 more on the basis of the information that that independent director would require of you, and the reassurance that would give us? Without a doubt, probably 2 or 3 times as much. And you know what? Some of the points they make might make you money in the meantime as well. And then your earnings will be higher, so the price will be higher. There's a time for cutting corners, and a time for flying by the seat of your pants, and a time for following your gut. And that's when you're building something, not when you're preparing it to be as attractive as possible to someone else. Sell at the top of your game. If you wait till you are too old, you won't get the money you deserve. Now, I skipped very briefly through our consulting career when we dealt with maybe 60 or 70 companies, typically turning over between $2 and $20 million. And I was involved with several what we now call zombie companies. But basically, the owner is too old. No offense, guys, we come to a certain point and that fight goes out of us. And I don't know what it is, and I think I've still got a few years, but it happens. There's no doubt about it. And you can tell, because everything hasn't been refreshed, and the margins are decayed, and the staff have all been there, and there's a general acceptance of, well, this is how we did it 15 years ago. And you won't get any money for it when it's like that. But by the time that hits you in the face in the mirror, it's probably a little bit too late. So you should be thinking, once I've had this and I'm at the top of my game with this, after all, if my concern is to get the most value for it, now is the right time. Because like I say, we've dealt with a lot of those companies, and they muck up certain markets too, because they don't fight for price, because they provide lousy service. So just be honest with yourself. Typically don't ask yourself, ask your spouse, ask your brother or sister, ask the people that you've respected for 10 or 20 years. They'll give you an honest answer. And on that score, get a group of people to listen to with this, from professionals to people who know you well. Like I say, it's an emotional decision. They will probably point out how you may or may not respond well to particular buyers, or how you will understand them. So don't see it as something where you need specific technical advice in a specific area. Like I say, it's one of the biggest tasks that you'll ever achieve. And just as a parent, I'm sure we've all listened to a wide variety of sources, take the same approach here. Which include reading books, things like this and all that. It's not something to internalise. Lastly, from day one, you should define it by saying, you have to be absolutely clear why a stranger would risk what could be their life savings to buy what you've got. Because that's what you're asking them to do.
Okay, so Paul's absolutely right. There are a lot of zombie companies out there that destroy markets because they can only compete on price, but their service has fallen off, their product has perhaps not been refreshed, and all they've got left of their war chest is, hey, I can do it cheaper. Very hard to sell. So what we look for when we go into a business is the trends of that business. Quite often businesses now are sophisticated enough to give us 5+ years of financial results. I would wish I could say the same about their monthly reporting or board reporting, and planning for that matter, but usually that doesn't exist over a long period. But the trends are important. If you can go back 5 years and see that that business did 3 million turnover 5 years ago, but it's doing 4.5 million now, and you can see the progress, and it'll be up and down, nothing's perfect. You can actually understand that they are winning in their market, whether that's because of population growth, or because of new technology, or because one of their competitors fell over. It doesn't matter, as long as you understand how they're growing, and they are growing. If you see a company that's in decline, you've got to ask the questions why. The concentration of the customer base kicks in there as well from a risk perspective. Again, if you have 70% of your sales coming from one customer, farmers, let's say you import women's clothing from China, sell it all to farmers, make wonderful margins for 3 years, and in the 4th year they may very well cancel your contract. So all that risk is sitting in one customer, and the buyer will look at that and simply say, I cannot risk my money on that opportunity. It's too much uncertainty. So the other things that help you get the right price is good marketing. Again, if you walk into a business and you're looking to buy, you look at how well laid out the business is, you try and measure the enthusiasm of the staff, get a feel for the culture in that business, and along with that comes the marketing that business, how it projects itself out into the wider world. Very important. You can tell a tired company where A, as Paul says, the owner has just passed it and the fight is gone. B, they've lost their way and they simply don't know what their competitive advantage is anymore. Or C, they're in a defensive mode where they're simply defending from a larger competitor that has a competitive advantage over them. So we want to sell our business, we want to sell it for the right price, we want to sell it at the top of our mental game. We also need to be able to sell upside. So if someone walks in the door, we can pitch them, yes, I've done well, but look at this wonderful opportunity coming forward. So you still need to understand your market and do your research into what the new market is. How are you going to get another 5% a year out of your key customers going forward? That involves having the right systems, the right sales reporting, the ability to pull out a report from your key sales guys to say, these are the leads that they're working on at the moment. Now, there may be a 3 or 6 month lead time for jobs to actually come through, but without that paperwork, without the ability to reinforce that your system works,